This is Quantitative Methods, and this is the reading on discounted cash flow applications. Before I get to the slide deck, I want to just remind you that Quantitative Methods is a series of readings that have applications throughout the CFA program. For example, candidates will be required to use time value of money throughout any and all topics. Statistical and probability concepts, sampling and hypothesis testing, boy, that can be applied in economics or to derivative securities or even to alternative investments. Technical analysis will probably be coupled with fundamental analysis. But that leaves us with today's topic, discounted cash flow applications. Now there are probably about two topics here that we're going to cover. The first one is capital budgeting. The second one is general investments and trying to determine a rate of return. But let's go ahead and start with capital budgeting. Capital budgeting is the process of planning for the purchase of long-term assets. And that means the process of planning for new and existing and improved product lines. I took a quick screenshot of the Johnson & Johnson webpage of Listerine. So when you think of capital budgeting, when you think of this discounted cash flow techniques, I want you to think of Listerine. I want you to think of good breath. I want you to think of how you feel after you gargle. And I want you to look at this. Notice that Johnson & Johnson puts a couple of different product lines available with Listerine. Different colors, different flavors. There's an alcohol-free one. There are these ready tabs. All of this stuff, these decisions that Johnson & Johnson made were the result of discounted cash flow technique and capital budgeting. That takes us to the first LOS. Calculate and interpret net present value and internal rate of return of an investment or project. So this is what we do. When we have a series of cash flows that occur over an extended time period, we have to consider things like risk and time value of money. And to do that, we use these two good methods. One method is called NPV, one method is called IRR. Let's go ahead and start with NPV. What exactly does net present value represent? Well, mathematically, there's a nice formula there. It's simply the present value of all of the cash inflows minus the present value of all of the cash outflows. And those cash outflows typically occur in time period 0. And this is evaluated at a given discount rate. So there's a good formula there. There's the summation sign, which means we're going to have a bunch of cash flows discounted at the discount rate, and then we're going to put a bunch of plus signs in between those cash flows. Now here's a good capital budgeting point. Companies most always use the weighted average cost of capital, which will show up in a future reading, or the WACC as the appropriate discount rate for capital projects. So I want you to think of the following. Where did Johnson & Johnson get the capital to invest in the Listerine product line? Well, they probably borrowed it from bondholders and borrowed it from shareholders. And the interest rate that the bondholders and the shareholders charged the company, that's known as the weighted average cost of capital. What's important is that weighted average cost of capital is a function of risk. That's really important. So we're actually taking the present value of cash flows using a risk-adjusted discount rate. Now, the net present value decision rule is quite an easy one. We're going to invest in any project if the net present value is positive, which means we're going to reject any project in which the net present value is negative. What are the steps to determine the NPV of a project? First thing, you have to identify all of the cash inflows and the cash outflows. And this is where executives really earn their salary and their bonuses, because it's very difficult to predict future cash flows a year from now, let alone 2 and 3 and 4 years from now. And so executives have to be extremely accurate when predicting those cash flows. Determining an appropriate discount rate, that's probably going to be the weighted average cost of capital, and there'll be a good formula in a future reading for you guys to memorize. And then use that discount to find the present value, sum the present values, and then you'll have the net present value. That's including inflows and outflows. And then make a decision. Let's take a look at an example. Let's suppose we have project X costs $20 million in upfront costs. So that's going to be an outflow in time period 0. Now, this is an interesting project because what's going to happen is it's going to generate cash flows of $5 million starting in year 4. And then those cash flows are going to increase by 30% in each of the following 4 years, in year 6 and in year 7 and year 8, which means that there are 0 cash flows in years 1, 2, and 3. Now, this is not too odd. Sometimes it takes firms a year or 2 before the product line can be introduced. In this example, we're just saying that it's more than 1 or 2 years. Weighted average cost of capital, 10%. What is the net present value for this project? Here we go. Let's use that big old formula right there in the middle of the page. So notice we have a bunch of plus signs, which I warned you about. We've got that minus 20 in time period 0, and then nothing in time periods 1, 2, and 3. So we can ignore those because the present value of $0 is, of course, $0. And then we're just going to discount those lump sums, the $5 million, then the $5 million plus 30%, and then the $5 million plus 30% squared, et cetera, et cetera. And if you do all that, you get a net present value of $4.52 million. And since that is greater than 0, we're going to say, therefore, accept. And what that means then is that if this is Johnson & Johnson and this is a new Listerine product line, the shareholders and the bondholders are going to be satisfied because we're investing in a positive net present value project. Now, I also hit the IRR button there, 13.62%. Let's hold off on that calculation for just a second and we get that to the next slide. But what I wanted to do is give you a shortcut. I'm a big fan of the cash flow button on your financial calculator. And so all you have to do is enter those cash flows. So notice what I did. Cash flow 0 is a minus 20. We know that. Cash flows 1, 2, and 3 are 0. We know that. And then cash flow 4 is 5. Cash flow 5 is then 30% greater than that, which is 6.5. Cash flow 6 is then 30% greater than that, 8.45, and so on. Then hit the I button for 10% weighted average cost of capital, and then just find your NPV button on your calculator and your IRR button on your calculator, and you should get 4.52 and 13.62%. I'll let you pause the video to make certain that you can do those steps and obtain the correct answers. But I'm going to go ahead and tell you about internal rate of return. Now, internal rate of return is another way to evaluate a capital budgeting project or evaluate an investment. And it has a little bit of an interesting slant on the discounted cash flow analysis problem. The internal rate of return is the interest rate that forces the net present value to be 0. So what do I have in the bullet point? It's the discount rate at which NPV is 0. In other words, it is the discount rate that equates the present value of the outflows to the present value of the inflows. And there's the general form. So that formula looks an awful lot like the formula that we just had for net present value, but what we're doing on the right-hand side is we're forcing the NPV to be 0, and then we're solving for the interest rate. And we call that the internal rate of return because it's the internal rate of return generated by this internal project or this internal investments. Think of a specific product line for Listerine, like those little tabs that you can throw in your mouth and you have an explosion so all your bad breath goes away. That internal rate of return is going to be part of the decision in which we will accept the project if the IRR exceeds that weighted average cost of capital. In other words, if the IRR, let's go back here to my previous example, the IRR was, 13.62%, and our weighted average cost of capital was 10%, so this is an acceptable project. So according to the NPV method, we accept because NPV is positive. According to the IRR rule, we accept because 13.62 is greater than 10. All right, a couple of things you need to know about IRR. IRRs can be positive, of course. They can be negative. And when are they going to be negative? They're going to be negative if, in fact, the cash flows are not sufficient to recover the initial investment. And for some strange reason, just by coincidence, IRRs can be zero. But here's the cool thing about IRR is that sometimes there are multiple IRRs that force the net present value to be zero, and sometimes there are no IRRs that force the net present value to be zero. So these are the issues with IRR. We'll talk at length about that in the capital budgeting reading. For example, it would be unwise to borrow at 10% and then invest the money at 8%. That's what an IRR less than the weighted average cost of capital means. All right, boy, that was a long first LOS. Let's get to the second one. All right, contrast NPV and IRR and identify problems. All right, that's what we were just doing, identifying some problems. Now, here's, you got to be careful. When projects are independent, the IRR method and the NPV method will always yield the same conclusion. In other words, if the IRR says to accept a project, the NPV will also say to accept that project. When projects are independent, so let's go ahead and define an independent project. That means that we are evaluating this particular product line by itself. We're not making any comparisons to any other product lines. On the other hand, if projects are mutually exclusive, then we might have a problem. The firm must rank the projects in order of profitability. When ranking projects, you should always take the directions from the NPV rule. And this is why. The NPV rule, remember I said this at the beginning of the slide, NPV measures the change in shareholder wealth. What's the goal of the business? To maximize shareholder wealth, and the net present value method explicitly measures the change in shareholder wealth. The size of the cash flows is much more important than the actual rate of return, the internal rate of return of a project. Now, the other issue is that what do you do if the IRR, if there are no IRRs? Or if there are multiple IRRs, then you have a problem. And so you always use net present value method because it explicitly measures the change in shareholder wealth. And that takes us through the first application of the discounted cash flow techniques, capital budgeting. Now we're going to kind of switch gears over to the investment field, and we're going to talk about rates of return. So this LOS asks us to calculate and interpret a holding period return. And this is a relatively simple calculation. Holding period return is the change in value of an investment over the period it is held. And so the holding period could be 1 day, it could be 1 month, it could be 1 year. But what we're going to see is that if a holding period is somewhat other than a year, then we need to convert it to an annual holding period return. And the formula is fairly straightforward. I always think of it as an F over P minus 1, but here's a longer formula. We start with the ending value, subtract the beginning value, and add any type of income that the financial asset pays, like a dividend payment or an interest payment, and then divide by the beginning value. So there's a good formula for you to memorize, but an example really illustrates this. 5 years ago, Robert Matthews paid $14 for 200 shares, 14 per share for 200 shares in an insurance company. The current share price has grown by 50% over that 5-year time period. And in that time period, he has received 12 dividend payments, each amounting to 5 cents per share. If Matthews decides to sell those shares at its present price, which is what, 50% more than 14, what will the holding period return be? So let's establish those values back in the formula. Let me go back real quick. Let's establish those values of P1, P0, and D. Do we have a D in this one? Sure, we have a D. So P is 14 times 200. So it cost Matthews $2,800 initially. And then he received some dividends there. There's the 5 cent dividend. He received 12 of them, and he had 200 shares, so he got $120 worth of, now note back here, this formula calls that asset income. And then he sold at 4,200. So where do we get that? He had the $14. It grew by 50%. So what's 50% of 14 is 7. So that's 21. And 21 times 200 gives us $4,200. So the holding period return then is the 4,200 minus the initial investment of the 2,800 plus the 120 in dividend income divided by the original investment. So that is a more than a 50% holding period return. But this is important. The holding period in this case is 5 years. That is a 5-year holding period return. All right, next LOS asks us to compare money and time-weighted rates of return of a portfolio and evaluate the performance of a portfolio based on these measures. All right, so let's start with the money-weighted return. Now, money-weighted return is an internal rate of return, but so is the time-weighted rate of return. So all of the technology that I showed you on those previous slides are going to apply to both money and time-weighted returns. They're both internal rates of return. They're both geometric rates of return as well. And so that should make perfect sense. Look at this next bullet point. It is the rate of discount at which present value of the cash flows equals the present value of the cash inflows. That sounds like a net present value of 0. There's our definition of internal rate of return. All right, here's a good example. Suppose you buy a stock, $25, sell it 2 years later, $32.50. And let's suppose you got an annual dividend. So you probably got a dividend at the end of the first year and a dividend at the end of the second year. What is the money-weighted rate of return? All right, so what we're going to do is we are going to solve for the formula that looks like this. Are you ready for this? What we know is that we're going to take the present value of the $1 dividend received in year 1, and notice that the 1 plus r is raised to the minus first power. This is done just to save some space. So we're going to divide. So that's really 1 divided by 1 plus r raised to the first power. And then you get the dollar dividend in year 2, and we divide that by 1 plus r squared. And then we sell it. We sell it right after we receive that dividend for $32. And what we're going to do is we're going to force that to equal 25. And so what the study guide asks you to do is to kind of guess. So guess at a number, put R in there as your guess, and then compute the present value. And if it turns out to be 25, you'll know that you guessed correctly. Well, that sounds like a long way to do this. So you know by now that I love using the cash flow button. So just do this. Cash flow 0 is a minus 25. Cash flow 1 is 1. And cash flow 2 is 1 plus the 32.50, and then just solve for IRR, and you get the 17.78%. Cash flow button is the beautiful thing. I'll let you guys pause the video to make sure you can obtain that correct answer. Now, time-weighted returns are the returns that are that do not consider an individual investor's cash inflows and cash outflows. What this time-weighted return does is it measures the compound growth rate of an investment portfolio, and so it's a geometric mean as well. It's an internal rate of return, and it's a geometric return. And so the difference between the money-weighted and the time-weighted returns is the following. Time-weighted returns is the return that's available to all shareholders in a particular investment. It's common to all shareholders. But the money-weighted return is going to be unique to each investor because some investors are going to own 2 shares, and then they're going to buy another share, and then they're going to sell a share, and then they're going to buy 5 shares, and then they're going to sell another share. And so their investment over time changes. The money-weighted return considers those changes. The time-weighted return does not. So let's go ahead and figure out how to compute the time-weighted return. We're going to have to do this the long way to start off with. And really, all we're going to do is calculate what you guys know as a geometric mean or a geometric return, where we're going to take 1 plus the holding period return for each period, and then compound that out, and then discount it back to the present by raising it to the 1 over the n periods. Let me show you what I mean by that. Let's suppose that we have an investor purchases a share of stock today for 200, and at the end of year one, buys another share for 220, and then sells both shares at the end of the second year for 230. All right, so this is going to be a different return for an investor that just bought at 200 and didn't buy an extra share at the end of year one and then sold at 230. That's going to be a different return. And there's some dividends in here as well, $3. So what is the time-weighted return on this investment? All right, so what we're going to do is we are going to first compute the holding period return for each period. And so what I want you to do is I want you to skip down to where, towards the bottom of the page where it says second, let's calculate the holding period return for each period. All right, so notice that holding period one, what did we do? We started out with 200. We ended up with 220. We got a $3 dividend. So that's 11.5%. That one should be okay. And then what did we do? Then we bought another share for 220. So that gets us up to 440. Then our total investment then is 2 shares at 230, so that's 460. So think about what we did during that period. We started at 440, we ended at 460, we got 2 $3 dividends, so we add 6 to that, we divide that by the 440 to get 5.9%. All right, so that part right there, under the second, we calculate the HPR for each period. That uses the beginning and ending and dividends paid value that is broken up for you there at the top of the page. And then the time-weighted return, all we do is take the 1 plus the 11.5% times 1 plus the 5.5%. And remember, that's 2 years. So to kind of decompound it, that's my word. To decompound it, we raise it to the 1/2 because it's 2 periods, and we get 8.7%. All right, next LOS asks us to calculate and interpret a whole bunch of different returns: bank discount yield, holding period yield, effective annual yield, money market yield for treasury bills, and other money market securities. All right, so let's identify these money market securities. So these are financial securities, financial instruments that mature in less than a year, like treasury bills, commercial paper, municipal notes, or bankers' acceptances. And so what do we know about these money market securities is that they almost always, they don't have to, but they almost always sell at a discount. And so there are a couple of different ways to measure kinds of the return on investing in these money market securities. So let's go through several of these. We'll do, I think there are 4 of them. Yep. So let's go back to bank discount yield. And so this is used to calculate the yield on treasury bills, quoted purely on a discount basis. So there's that discount again. So we take the face value minus the price, which is going to be less than the face value. So the face value of a treasury bill, let's say it's $10,000. So the price is going to be, $9,940 or something close to that. And then we adjust it for time. The holding period yield is exactly like we just did back in the holding period return. The holding period return, and it has the same formula there. And so holding period yield is now what the term is when we're relating it to money market securities. The effective annual yield, and I warned you about this before, if the holding period return, or in this case, the holding period yield, is less than a year, we have to annualize it. So that's what the effective annual yield is. And so notice that we use a 365-day year for the effective annual yield. And then the money market yield swings us back to a 360-day yield. That's a convention that goes back hundreds of years, maybe not hundreds of years, but a long, long time, before they had computers just to make life simple. It's really hard to divide by 365, so you could easier divide by 360. And there's the money market yield given a bank discount yield. All right, so let's go ahead and talk just a little bit more about these. If you're given one of these, you can easily find the others by considering the point that the holding period yield represents an actual return on a money market instrument, but here's the big assumption that it's held until maturity. And when we annualize the holding period return on, the holding period yield on the basis of a 365-day year and carry out the compounding, the result is the equivalent annual yield. And then the money market yield is the annualized version with 360 days. And so let's go ahead and do a problem here. Suppose we have a T-bill selling at $990, matures for 1,030 days. Let's compute all of those things there. So there are the formulas, and there are the inputs given. We have a $1,000 face value. We've got a price of $990. We have 30 days. So we're just going to input those into each of those formulas, and we're going to get 12% and 1.01%. That's 30 days, remember. And then we're going to annualize that in the effective annual yield. So we compound that out using the 365. That gets us to 13%. And then if we annualize it using the money market yield, we use just the 360 days, and we just multiply by 12. In this case, 360 over 300, and that gets us 12.12%. So I'll allow you to pause the video to get caught up in the mathematics of that page. A bond equivalent yield refers to the annualized periodic yield calculated by multiplying the periodic yield by the number of payments in a year. And, kind of the convention here is that since bonds pay interest semi-annually, that's why this is called the bond equivalent yield. And so the yields are quoted as twice the semi-annual rate. Let's go ahead and do a quick example here. We have a 3-month loan, holding period 4%. What is the bond equivalent yield? So first we convert that to an effective semi-annual yield. So we add 1 to the 4%, 1.04 squared. So we're squaring it to get from 3 months to 6 months. Subtract 1, that gets us up to 8.16. And then we multiply it by 2 to convert that semi-annual yield into the bond equivalent yield of 16.32%. And that takes us through our discounted cash flow applications. That was fun. We did some capital budgeting stuff, and we did some let's figure out what rates of return looks like, especially in the short term. Up next, statistical concepts and market returns.